So as I said before, last week, this week, this week, probably is the most sophisticated sessions that you're going to have in 385F. The reason is that you have a lot of theories to remember, a lot of formulas to remember. Well, the good thing is, what I want you to do is not do the calculation itself, but try to understand the logic behind why do we need to use standard deviation to estimate the risk? Why do we need to use the portfolio theory or any other formula? So this is something that I hope you guys can learn. So before we begin, we actually started the game already. Your assignment number 2, which you have $500,000 US dollars, and you can invest freely in the US market. It can be equities, stocks, can be fixed income, bonds, and commodities. I think you can actually even do a leverage. So some of you made a really good, very impressive performance before the game started. So as I said, at the game started on February 8th. So whatever you did before, I already put in the record. And for those who actually participate early, I will definitely give you back the bonus point. So what happened is on February 8th, which was 2 days ago, you're going to have almost 2 months to finish the game. In this 2 months, you can try whatever you want. You can formulate investment strategy. You can play around first for the first 2 weeks, and then try to formulate your own game plan. So it is up to you. But the key is, the more trades you do, the more you can write about in your assignment number 2. And in your assignment number 2, it's actually very easy, because the more you can write, that means the more takeaways you have. And the more takeaways, that means you have higher score. And that's it. I'm not going to judge your English. I mean, of course, like we at least have to meet the minimum standard. So try your best. Invest in something, get the lesson learned. What is the takeaway, and then you write it down, and that's it. Because what happened was, I'm a portfolio manager even now, so I'm not sure you guys said that. Actually, I didn't even tell you about this. I'm a part-time lecturer here. So my full-time job is actually working in a fund in Hong Kong, open-ended fund, and then I have several clients that I need to manage their account. So whatever I'm showing you right now is actually exactly the things that I do, like on a daily basis. How to evaluate the market, how to evaluate the portfolio. So if some of you able to dig up my information, you may be able to find me in some newspapers column. So I will do all the macro things, and I will tell you actually first before I release that to the publisher. So everything I said is actually not just on theory basis, not all from the academic standpoint, but actually everything is practical. But this part right here is unfortunately has to be shared with you, because this is essential. This is important, because this is the foundation of investment, foundation of well, not necessarily finance, but foundation of investment. So you have to understand it. So make sure you understand what is the risk of an investment. What is the return? How to calculate the return? So we talked about all of this, right? So this one right here, I think we left off here at job ratio and information ratio, and I think I even repeat my my speeches because of this. This is fairly important, because when I show that to my boss, when I show that to my client, this is exactly what I need to tell them. How much risk I'm taking, what is the appropriate return. And as I said, there is a professional body, the Chartered Financial Analysts, CFA. They have guidelines of how you should calculate your return. You can use a simple average, but that is not what they accepted. You have to use geometric return, something like this. Right? Okay. People use job ratio, but in reality, I was being judged by using the information ratio. The difference between the Sharpe ratio and information ratio, as you see from these two formulas, the upper one is Sharpe ratio. We use the risk-free rate as one of the component, right? So what happened is you try to calculate the total return minus the risk-free rate. So if the bank deposit is about 5% right now, or 4% right now, then your return of 10% or 15%, minus the risk-free rates, that will be your the premium, the excess return, or the excess return, EXCESS. So the extra return that you're going to get from the bank deposit. Why do we need to use the risk-free rate here? You think about this. If I don't use something to compare, then there's no way you can see how good you are, right? I mean, you can tell people, hey, I'm making, so let's say back in 1980s, if you tell people, hey, I'm making a return of, let's say 14% a year, oh, that's awesome, that's good. But if I tell you at that time, the bank deposit rate is 20%, then you said, hey, why don't I just put money in the bank instead of getting the money to you? Because at the bank, you get 20% return. But for you only get like 14%. So this is for comparison. And this is why we use the risk-free rate. So this is the Sharpe ratio. Then the bottom one, information ratio. The information ratio IR, they don't use the risk-free rates. They use the market rate or the benchmark rate. So when I was with the state administrator of foreign exchange from China, they don't use the market rate. They use the benchmark rate. So this is good, right? I mean, they give me the benchmark and then I compare my performance against the benchmark. And then you believe that you probably can imagine this is a huge pressure. Because, hey, if SPX is running a 30% return, then I have to beat and I have to outperform SPX. SPX is Standard & Poor's 500. So I use a lot of acronyms, and if you don't know that, let me know. So SPX, I remember that particular year, 2013. 2013 SPX annual return was 30%. So it was really hard to outperform, right? Fortunately, my return was 33%. So I only outperformed the market by 3%. Even though it is 3%, but the good thing was it was lucky. I was really lucky. And the portfolio returned by 33%, but you try to imagine you are managing a $50 billion portfolio. That is from the country. So the government trusts my ability. They gave me like $50 billion. That is actually the largest fund in Asia, not even in Asia, but probably largest fund in Asia managed by only a single person, portfolio manager. Running $50 billion, gaining 33%, that's close to $17 billion in a year. That's huge. But then the market return was 30%. So I only outperformed 3%. I was actually very proud of myself. Hey, I told all my like future bosses that my return was 33%. They said, wow, that's awesome, that's good. And 33% based on a $50 billion portfolio. That's good, right? But they never understand, hey, the market was actually up by 30%. So I wasn't like really that good. I only outperformed the market by 3%. So this is how the market participant played in this game. And in your what is that called? We need to do the polling. Yes. In your polling today, which hasn't been released yet, I'll release that later today. In your polling, the first question you will be asked is, what benchmark do you think you should choose in this particular game? And then you say, hey, why do I have a benchmark? Because I don't know if you're performing good or not, right? So you choose the benchmark, and I will use the class average to pick the one that is appropriate. Last year, maybe 30% people choose Hang Seng Index, 20% choose the US S&P 500 SPX Index, and then maybe 10% choose the NASDAQ. So you think about this. Choosing what benchmark is good for you. you always want to choose the lower performance benchmark, right? Because you want to outperform the benchmark. You want to outperform your reference point. Well, then you have to make a guess. I gave you several options. One is S&P 500. You haven't don't worry, you won't be able to see the polling yet. I haven't released at this point. So there'll be S&P 500. There will be Dow Jones Industrial Average, DJIA. There will be NASDAQ, and there will be an index called Golden Dragon in the US. And the Golden Dragon Index is actually the US stocks that is actually listed in the US, but it's a Chinese-based company. So let's say Tencent, Alibaba, or even like KFC. It's actually listed in the US. So they form this group of companies, I don't know, 20, 30 of them, and become the Golden Dragon Index. So if you want, you can choose the Golden Dragon Index. This index has been underperformed for a long time, but hey, in the last 6 months, this particular index has been outperformed by everyone. So you make your choice, and then I will do the weighted average, and I will show it to you what is the outcome that you guys choose. So that is the market rate right here. And last week we talked about this, and I'm not going to go into this. Portfolio A and portfolio B, which one is better? And then if you calculate the Sharpe ratio, portfolio B is actually outperforming portfolio A. And if you can see from the chart, B is actually sort of better than A if you can just eyeballing it, because you got the similar risk, which represents by the standard deviation, but then you get a much higher return, right? So portfolio B should have a better Sharpe ratio. So in this case, so try to understand the numbers here. And then again, if you include a risk-free portfolio, risk-free rate is 5%, then you get the ultimate risky portfolio, which is P right here. This is the tangent, the touching point from the efficient frontier. So the EF, the curve here, to the CAL line, that's P. And that is the ultimate portfolio. So pretty much this number will have a maximum Sharpe ratio. So try to understand the calculation here. I mean, it is not that hard. If you, I'm sure that you guys went through high school, junior high school. So in this case, then this should be fairly straightforward. And then, of course, this one will be different because we apply the clients in different curves. So the client's risk appetite, and then the point, touch on point is curve CAL line. So what happened? Look at this particular slide. This is a typical portfolio for, I mean, more like a proper portfolio for a typical individual. You will have some stock portion, and you will have some bonds, and you may have some risk-free asset, which is T-bills. T-bills, T stands for treasury bill. Very, very short-term US security, fixed income security. So they have a quarter of that. So by looking at this portfolio, I can pretty much assume that the individual, it's about like a middle age or even a retiree with a heavy portion between will be the fixed income asset. So this will be the portfolio P, and then this is the risk-free rate here, and this is showing you how to calculate this. So first of all, expected return, ER overall 9.46%. That's just a weighted average. So you have the weight of Y and 1 minus Y. If you guys remember that, so 74%, 25%, 26%. That will be the combination of the risky portfolio, right? And then once you combine this, and then you will get the expected return of 9.46. So in your exercise, in your market watch game, you can do something like this. You say, hey, your risk-free will be cash. So let's say you $500,000, you maintain 10% cash, $50,000. 90% to invest in stocks. That's no problem. But in your in your paper, then you can write why you want to hold that cash. You can actually calculate all these here. In my portfolio, my maximum holding of cash by the regulator, because it's regulated by the government unit, cannot exceed more than 10%. So I can only hold 10% cash. And then, so in this case, if I expect the market is going down, 10% cash is whatever I can hold. But some other fund, they can actually hold more cash. As I explained to you last week, some of the multi-asset class funds, they can hold up to 40%, even 50% cash. In that case, in the last year, all these guys outperform the market, because what happened was they hold like 40% cash. Why do you invest in them? For them to hold cash? I mean, you want them to put your money in action, right? You want them to use their brain, to use their intelligence to invest, but not just holding cash. If they're holding cash and then they charge you the management fees, then why do you want to pay for that? It will be similar to something like this. You can get a bottle of water for free, but I'm going to charge you right away, right here, right now, for like $1 per bottle. Why do you want to pay me the bottle of water? That's the same thing. So think about this, how you construct your portfolio, how many percent in stocks, how many percent in bonds, or even in T-bills, and then you explain. Because you believe the market is going down, and then you invest more in this cash and then bonds. There is no limit. You can say you invest in 90% cash. Last year, there was actually a student actually invest 80% in cash, and then 80% in cash, 20% in fixed income, 20% in bond. But of course, like she lagged behind by a lot, because the market was actually going, it was actually going higher at that point. But it's all right. I mean, her paper was actually running really good analysis. She included all these calculations, showing me the lowest risk, the standard deviation, volatility, and everything was fine. But it is up to you how you persuade us if you don't do any trading. Because you'll be asked that question in assignment number 2. So this is it. Of course, like that's the standard deviation, that's the expected return, 9.46%, and the standard deviation. So it will be only for this particular part here, the risky portfolio, times the 14.2%, which is the standard deviation of the portfolio. That will get you the weighted portfolio situation, and then you'll get the Sharpe ratio by doing this, so 0.42%. And why do you have no standard or zero standard deviation for fixed income or cash? Because you can assume that, well, even though they have a small range, maybe 1 to 3%, but usually we will treat risk-free asset as zero standard deviation. So in here, this particular formula, it's a weighted number. It should be plus 25 or 26% times 0%. And that will get you a 10.56, but we just cross that out because the standard deviation doesn't matter. But this particular formula is just a very, very this formula is actually works out well. Why don't we have the residual? As I said, you have if you want to calculate standard deviation, you have the A plus B bracket, that's square, right? And then you should have a 2AB. Because when you have a risk-free asset, your 2AB will pretty much eliminate, because there is no direct correlation between the risky asset and the risk-free asset. So that the term 2AB will become 0. So whatever asset you add to a risk-free asset, that's good because it's easier to calculate. So all you need to do is doing the weights times this, and you will get that. So very, very straightforward. And then, of course, like as I said many times, identify your universe, your investment universe, construct your capital asset line, capital allocation line, and then you will formulate the different portfolios, applying the risk appetite from the clients, and then you will find the portfolio line. This is the theory, and of course, in the real life, no one cares about this because what I'm saying is it is hard to find the indifference curve right here. So not I don't think there are even institutional level we'll try to construct something like we'll try to construct this. But things change. Things really change. As you know, a few days ago, Baidu announced something, right? Do you know what that is? Awesome. ChatGPT. It is the first, probably the first AI, well, maybe probably the second version. This will help financial institutions, brokerage firm, investment managers to identify this particular risk right here, this indifference curve. But that will be perhaps 10 years down the road. So you will see this, you will encounter this in your life. Before that, it will be really, really hard for even my generation to come up with something called efficient frontier. Now it is actually very easy. So for your generation, it won't be hard to calculate or to come up with something called the indifference curve. It won't be hard at all. And in this case, this theory will become practical. I'm not saying that this is actually like a waste of time for you to study this. Everything up here is in a theory, and people study this for like the last 40, 50 years. It works, but then in the practical world, it cannot be worked. So all the professor will say, hey, we got the capital asset allocation line, all the CAPM stuff, and then blah, blah, blah. But in reality, it is really, really hard to put this at work. But nowadays, with the ChatGPT, I think it will be easy to come up with the indifference curve. And with that, with the super computing power from the PC nowadays, it won't be hard to come up with something like this. So to summarize everything for this and also last week's lecture, it's allocation and diversification. So remember this: you don't want to put all your money in one stock or two stocks. And I know that some of you did put $500,000, but they put $400,000 US to buy one stock. Day trade. I bought the stock at 10 p.m. and then sell it at 11 p.m. Hong Kong time. Yes, that works. Because in reality, there are a group of people actually doing this. They believe that they can spot the weakness of the stock or the market, and they keep doing this and replicating this. So prove it to me that you can consistently outperform the market, because I personally haven't seen someone like this. I heard there will be people like this, but you try your best. You try your best. Try to explore your talent. Try to explore the strategy that you want to work for. So this is the allocation and diversification. And I know that the assignment number 1 is coming up very soon. As I said, you can skip the lecture. It is up to you. I know 9 o'clock, 9 a.m. is really, really early for you. But remember, but I got to tell you this. I woke up every day at 5 a.m. and try to digest the US news, European news, and then I try to read all the news I can. What happened with the US market? What happened with the Chinese market yesterday? Even though I have read it last night. But this is how a good investment manager should perform. And I know that you guys have been staying up late at night trying to participate in that game. But try to think of a better way to use your time. One good thing is, well, maybe not a good advice, but I got to tell you this. Once you participate in the stock market, it will be really, really hard for you to get out. Because once you put the money in force, your own money, you can never forget your money is in the market. And that means you will keep watching your cell phone, you will keep watching the internet, even when you're at night, even sleeping, dreaming. And this is what I have been doing for the last 2-3 decades. But for you guys, I know some of you are not financial investment focused. It is fine, but try to get a taste of that. So try to balance your time, because you can never ever find any particular job that will be as crazy as this one. Then you have to absorb all the news and absorb all the noises and to analyze it and identify which one is actually helpful for you. So for lecture time, I go easy guys on you and just remember this, do the polling. And I usually we'll set up the polling, I don't know, 1 p.m. And you have like 6 hours to do it. So probably by before or 5 p.m. or 7 p.m. today, the lecture day. Usually 2 to 3 questions. So you don't need to do the polling right now. So I break all the rules, as I said. But for tutorial session, I don't even recommend you to go to tutorial session. It is mandatory. So go to tutorial session, listen to what Eva said, and she will discuss with you in details the assignment, the ICA, and also the quiz. The most important one, of course, is quiz. So attend the sessions. So this one, I told you last time, you can actually search this from the internet, and I want you to search it from the internet. Don't just copy from here. Do the search yourself. How do you calculate 3 asset portfolio? Of course, if you don't want to bother yourself the time doing the search yourself, then you can actually do this. This is also in the PowerPoint slide share with all of you. How do you calculate that? You have 3 parts, and as you can see, there will be 3 parts here: 2AB, 2AC, and 2BC. This is why when you are running the estimation of risk of a portfolio, you will have a lot of residual, you have a lot of noises, and calculating the correlation between 2 assets. And this is how this is pretty much like the most complicated theory formula that you can encounter. But if you are able to do 3 asset portfolios, and my question is, are you able to do 4, 5, 50? The answer is definitely yes. If you know how to use Excel, this 2AB, 2AC, 2BC will be like a matrix. If you have a 50 stocks portfolio, it will be 50 rows, 50 columns. And then the matrix is there, and then you just sum that up. And that's it. So very, very straightforward, very, very easy. So when I was at your age, I was actually able to do that in Excel. I was actually quite interested in investment. So I was learning to do all this and trying to do actually not 50, but actually I was trying to do 25. At that time, Excel was the very, very old version, and at that point of time it was a Windows 97, so it was not even a Windows 10. So 97 is higher than 10, right? So it was a Windows 1997. So at that time, Excel was just released, and it was really, really slow for them to calculate 25 stocks portfolio, but they are able to do that. So think about how you can calculate all these portfolio return, portfolio value. So this is the hint for question number 5, assignment number 1, question number 5. And that I think that probably is the hardest question if I remember. Any question? Awesome. Let's do this. That should be. So we have 2 more PowerPoints here, probably. So I need to cover some boring stuff next time in the first half. And then we'll be done. And then it will be something like that will be very, very interesting to you. Because what I'm going to show you is I'm going to show you 3 different asset classes. The first one is equities. Everyone wants to ask that question. Second one is bond, fixed income. No one really, like at your age, no one cares. But if you remember this, remember what I said, I'm sure that like 40 years from now, you'll start to concern about what is a fixed income. And then the last one, with options. So for those who are very speculative, who really wants to make a lot of money in the game, not just in the game, but in real life, then it will be the options. This is how you can leverage yourself. But first of all, equity. I will show you how to read the charts, how to construct the chart, how to read the lines, how to read simple moving average, SMA. How do we calculate RSI? You heard people talking about RSI. You heard people talking about MACD. You heard people talking about like the Bollinger Band. What are the Chinese term? I can't remember that. But you have all these. You have all these indicators, the signals, and I will show it to you all. What is the proper way using a technical analysis, and what is the proper way to use the fundamental analysis? For myself, for me, I will use the fundamental analysis, but then a lot of my clients, they prefer the technical analysis, so I need to learn both. So what is the difference between these two? And then you if I have to say is, hey, what is the difference between the basketball and football? Or the question is, what is the difference between taekwondo and karate? Well, yeah, the same thing, but it's just how you can play around with the ball and how you're going to use different style to attack. At the end, the objective is, how do you kill your enemy? And now I'm teaching you the most efficient way to do that, and what is the usual way other people are doing this. But before that, let me wrap up the sort of the boring stuff first. So CAPM, capital asset pricing model. So we the short form is a CAPM. People talk about using the CAPM model. So this is not the CAPM, Captain America that you heard of, but this is a CAPM way before CAPM is being released back in 1940s, 1950s. So think about this. This is all the words. It's a set of expectation about the stock and also the market, and there will be an equilibrium. And then two sets of assumptions: individual behavior and the market structure. If you're able to break these rules, then you can actually you're able to find the investment opportunities. So they have this Markowitz. So I'm going to introduce more famous professor to you. So Markowitz. So when especially when you finish investment management, don't say that you don't know these persons. So Markowitz established the modern portfolio management in 1952. When he when he wrote this paper, there is not even a there is a simple calculator, but it's not a calculator that you are using. So at that point, when he was doing the all the standard deviation thing, it will be extremely hard. It's going to take him a long time to even to do a 10 stock portfolio standard deviation to calculate the risk of a 10 stock portfolio. So it was really hard. And then he has this kind of idea. But of course, nowadays, all these things can put in Excel and run it, and actually it proves right. And then Shaw is a person as well. So Shaw and the other two professors published the CAPM also in 1964. So these are the assumptions. So you have the individual behavior. The first thing has to be rational. Do you think the market is rational? And of course not. The market is never ever rational. But the market is always right. So even if this is irrational, but the market price is always the price that you see, right? So investors are rational, and then they have a common planning horizon, single period. Is that right? Is every single one of you will have the same investment period? In the assignment number 2, yes, you all have 2 months, right? But for my clients, there is actually a much old lady, 75 years old. I don't know, her investment horizon probably will be like 10 years. But I got a guy, 35 years old. His investment horizon probably is like another 40 years. Investment horizon is different. But in CAPM assumption, they assume it's a single period. Yeah, everyone's the same. And then, of course, like homogeneous expectation, everyone wants to make money, and that expectation is the same. They have the same market expectation, which means that they expect the market will have a return of, let's say, 15%. Everyone will see that as a 15%. That's it. So, but this usually will not be the same, right? Some people will believe, hey, the market can go up to 30% this year because it's already like what 15%. So it is very, very possible that people will have a different expectation. And then for market structure, crazy thing about this is there's no taxes, no transaction costs, and investor can borrow or lend at a common risk-free rate. This will never happen. Do you think Li Ka-shing can borrow at a lower rate than I do? Of course, he can. Probably the bank will give him money for free. So even the second, the part B2B is not going to be valid. But you see, this is how the economists said. I mean, they always have all these assumptions. These probably impossible assumptions. So this is how the how things work. And of course, like in CAPM, there has to be a component, and that one is the market portfolio. And the market portfolio is all the stocks, and then the market value of the stock. So that will be very, very straightforward. It's a risky asset. That's market portfolio. Everything you see, everything you learned in the last two lectures, it's already here, so you have the efficient frontier risky assets, and then this one is the capital on market line. These two are the same. So standard deviation, so remember the x-axis, the one horizontal, because that is a major difference. X-axis is standard deviation. So capital asset allocation line, capital market line, they are essentially the same. So the one CAL, there can be a lot of CAL to different degrees, but the one single one, there's only one. The one that actually touch upon the efficient frontier, that is called the CML. So this CML is also part of the CAL, but this particular point is the market portfolio. So you can see these two are the same. So you learn all this, right? What happened is with this particular chart, then we are able to do come up with a stock expectation, or maybe the security expectation, and then where the market portfolio is. So here is built on the insight, and that the appropriate risk premium on asset is determined by. You see, I'm not going to ask you because you don't remember that, because I never remember this works as well. But what I want you to do is they will use the market as the optimal risk portfolio. In that case, every one of you should invest in the market, which means that if your investment universe is Hong Kong, then you should use Hang Seng Index. If your investment universe is in the US, then you should use, let's say, S&P 500. Right? So that, because that is the optimal risky portfolio. Why we have a lot of retail investors invest in different things? Because you believe you can outperform the market. You believe you want to take more risk. That's why you have all these crazy noises around you. And for CAPM, there will be an expected return beta relationship. So I introduced one thing to you, beta. So what beta is? So this is a Greek letter. I'm not sure how familiar you have with the Greek letter. So in English, you have A, B, C, D, E, and all the way to Z, right? Zebra. In Greek, they use a similar a structure, but I think they have from A all the way to I can't remember. It's 20 alphabets, only 20, but not 26. They don't call A, they call alpha. They don't call B, they call beta, and there is no C, and then they jump to a D, delta, and then after delta, it's gamma. Sounds familiar, right? What does that mean? What is Omicron? Now you know what happened. Omicron is the COVID one of the deviation of COVID original strain, right? Omicron is, I don't know, the 8th or the 10th alphabet from Greek letter. So even in the medical world, they will use this to line up with a different string. So alpha is the one, and we skip that, and then beta when they kick in, and then I think it may be the first wave or second wave, and then they skip several one of them, and then they come up with the Omicron. It was the fourth wave or the fifth wave. And you know what's after Omicron? It was actually XI. And why do you want to skip that? Oh, there could be a lot of political reasons for that. So I'm not going to go into that, but hey, you can check out the Greek lab. And there is actually, I heard that they intentionally skipped that, and even the World Health Organization, like the major organization for the world about this to name this virus. They intentionally skipped that. But then after that, they have another BA 1.2 or whatever. But it is a different thing. I don't know how that works. But in here, it's very easy. You will hear the term alpha later on. But first, I want you to understand what beta is. So risk premium is the benchmark risk premium. So anything that is above the risk-free rate. So there are different terms. I told you like half an hour ago. Excess return, that's also risk premium. It's equivalent terms. So anything above the risk-free rates, that's the risk premium. And you can see here, security market line. So out of these 4 lectures, beside the portfolio return, portfolio standard deviation, portfolio risk, whatever that is, this is the second thing that I want you to learn. Because when you claim that you finished 385, you claim that you finished the investment management course, you claim that you attended my session and you don't know SML, then you fail. I fail. So I want you to understand this. First of all, it's the CAL line. The second one is the SML line. They look very, very much the same, except the fact that the x-axis, it's no longer standard deviation. You watch that, it is beta. So pretty much the entire chart replaced by beta. And if I replace the chart by beta with this this symbol here, this line will call the SML, and this particular chart is the CAPM, capital asset pricing rate. This is very important because it will be in the ICA and it will be in your quiz. Definitely will be in the quiz. So I just need to remind you, because this is something investment 101, very, very basic things that you need to learn. Again, straight line, you got the risk-free rates, you just have a different label. So in the exam, you may see a chart and I'll ask you what that is. And then you have to tell me, this is SML. Well, you get at least half credit, right? Write the entire name. Security market line, you get a full credit. If this is a standard deviation, and then you say, hey, this is the capital asset allocation line, CAL. And then you label what is the efficient frontier. So this is actually a primary school fill in the blanks, right? Very straightforward. And it is that easy. But I want you to know what's going on. And there will be some very, very short let's say description. What is we may ask you, what is SML? What is CAL? What is why do you want to use this? Things like this, but we will prepare you for all the questions. So the same thing, SML, you have the slope of the SML, you know how to calculate a straight line. The formula y equals mx plus c, it's very, very easy. And then you have, let's say if there's any deviation, anything not on the SML, what is that? So you let's say you identify a stock above the SML. That particular part here, you see there's a little sign, it seems like an A, right? This is not A. Well, it is A, but this is the Greek, another Greek letter, alpha, ALPHA. Have you heard of what is alpha male? Good. Alpha male, if you are in a gorilla, so those huge, not monkey, but it's like a huge, or monkey like monkey, I don't know what that is, but gorilla, those things, you can only find one alpha male. So alpha is the biggest, alpha is the largest, alpha is the heaviest. And in the investment term, alpha means extra return. and you only show, they only have like alpha always stand for extra return. Beta, on the other hand, is not about extra return. Beta is about the risk of, let's say, the beta of the risk of a security against the market. So what does that mean? What does beta mean? So alpha, you see, it's extra return, right? So let's say if beta is 1.0, what is 1.0? Remember this particular chart, 1.0 of beta means it's a market. It is a market. What beta means is 1.0 means when you have a stock or maybe a market. But let's say a stock, this is the market, right? Beta 1 means when the market moves up, the stock moves up. The market goes down, the stock will go down the same percentage. That's beta number 1. If you have a beta 2.0, positive 2.0, what does that mean? Let's say this is market. This is the stock. 2.0 means when the market moves up 1%, it moves up 2%. Much wider deviation. What about if beta is 0.5? Same token, market, beta, market stock. The market moves up here, it will still move the same direction, but then it will be half of what the market moves. That will be easy, right? If I understand, hey, what the beta of a particular stock is, then I can see if the market moves up 1%, the stock of that the stock will move up by 0.5%, right? Yes, this is the key. And where can you find the beta? If I show this to you right here, so one particular app I always use, there are several, 3 of them that you should know. One is Yahoo Finance, one is investing.com, and one is Bond Smart, Bond Supermart. I'll show that to you. But one thing is, you got to remember is, let's say if I go to Yahoo Finance, which company you want to see? Tesla? How come everyone loves Tesla? Yes. Wow, who bought Tesla yesterday? I heard a lot of noises. So Tesla. That's beta. You see I highlight the number here? Beta. So let me ask you this. What do you think 10 cents beta will be? 10 cents. Above 1 or below 1? Maybe I'll ask you this question. Above 1, right? Let's see. Above 1, right? Let's check it out. Oh my goodness. Oh my goodness. Is that right? It is actually right. Because what happened was the market moves much wider than 10 cents. Or let me put it another way. It may make sense. It may make sense because 10 cents was in a one-way direction going down, but the market can be going up and down all the time. Let me ask you this: what is the another stock? HSBC, Hong Kong Bank. What do you think the beta will be? Above 1, below 1. 0.5 to 0.7. Wow, that will be impressive. It's actually even higher than 10 cents. But if you check, what do you think this Power Assets Holdings, 煤氣, 中華煤氣 in Hong Kong, it's the guess. Above 1? I'll be curious as well. 0.53. You know what this is? This is actually the utility company in Hong Kong. When you have a utility company, usually stock will not move that much, so you can see a 0.53. So in this case, you can actually use beta to see if the stock that you invest has an extremely volatile compared to the market or not volatile compared to the market. So you can, it is up to you how you can see if we put this in the context. Tesla beta 2.1, then you definitely expect a lot of return from this stock, right? If 10-cent beta is 0.6, then you probably believe that, hey, it is below the market return, right? Well, the number tells whatever that is. But remember this, the beta is not a forecasting tool. The beta is calculated by, according to that Yahoo Finance page, is the monthly return in the last 5 years. So it is the historical number. It's not forecasting. So remember this. So you can put Tesla here on this chart, and you can put 10 cents here on this chart. But Tesla definitely will be in the upper right-hand corner, and 10 cents will be in the lower left-hand corner. The point is Tesla above this SML or 10 cents above this SML? Even below the SML is fine. I mean, as long as above the SML, you make the alpha, right? What you want to do is you want to capture the alpha. So for the one last formula before I give you guys a break is this particular formula. Again, very straight line formula. If you remember the straight line, y equals mx plus c, then you have the extra alpha, and then you have the beta, and then the market. That will be this particular point here, the stock. So how do you use the formula to represent this stock location? This will be the formula. You have the alpha, you have the beta times the risk, the market portfolio. So beta times market portfolio, you get this one right here, and then plus the alpha. This is the location. So this particular formula will be the one. But the last terms here, this one will be a very critical, because in theory, this one is every professional is trying to calculate the epsilon. The epsilon means the abnormal return. And we'll talk about that later. So the fundamental assumptions and distinctions. CAPM is built on uncomfortably restrictive assumptions. As you can see, it is all crazy, right? So let me wrap this up. I think that. So remember this particular point. This is the CAPM model. This is the SMO line. The risk-free rate, everything is the same except this one, x-axis is beta. That's it. All right, let's take a 5 minutes break and we'll be back. All right.
喂，如果forecasting 咧，即係佢如果佢唔係 forecasting 冇咁嘅，有啲乜analysis for process，除咗個 matrix，即係個 correlation matrix。
單真㗎，唔係今堂就下一堂教，有一個叫做 multi-factor model，叫 MFM multi-factor model。咁你上完嗰堂先，跟住你自己諗下佢點樣可以去 predict 佢。其實 forecasting 咧就好多方法去做 forecasting。咁有啲咧呢個咧係叫 one factor model， 要個 beta 嚟做。即係我用之前 historical 嘅譬如 2.1 學 Tesla， 你就預計個 market expectation 可能今年可能 market 會有20% return。 咁你20%，
哦，即係 market 有20%，
你估 market 有20%，
OK，
佢之前用2.1，咁你咪睇14.42%咯。但係呢個梗係唔準㗎啦。
因為佢係5年嘅 data 啊嘛，即係如果
historical。咁我哋試下，如果我將唔用一個 beta， 我唔係淨係用嗰個 test against 我用多譬如其他嘅 factor， 譬如公司業績，跟住之前佢嘅公司嘅 credit 嗰個 leverage， 或者係 financing leverage， 或者係其他嘅 earning 就好嗰啲其他嘅 factor 加埋佢，咁你就唔係淨係一個 beta，
咁冇複雜嗰啲，
可以複雜。
但係呢個有冇機會可以揾到Python 啊、Excel 啊，任何呢啲？
我覺得算。
因為我就走呢一面嘅，我唔係好記識嘅，我係好中意攞啲嗰啲嘢，跟住之後就砌嚿 model 出嚟。
係啦，咁冇辦法，因為你嗰啲 multi-factor model 唔好，你諗下，你個 beta 最唔計啫，你係個 stock return against 個 market return， 咁兩個嘅 correlation 就變咗個 beta。
係。
咁你有個另一個跟住我之後講個 multi-factor model， 就係講緊用公司嘅 earnings growth， 或者可能用revenue growth， 跟住或者可能佢嘅嗰個叫做 interest coverage。咁你每一個都會去 measure against 個 stock return。咁呢個 model 就變咗 multi-factor model， 所以每一個 term 都要 run against 呢個公司即係公司嗰個 stock return。咁你可能有5個 factor、10個 factor、20個 factor。咁有一間公司Barra， 我遲啲再講，佢有13個大 factor， 下邊有成50幾個細 factor。
BARA
係啊 ，BARRA Barra。咁 MSCI Barra， 咁佢有成50幾個 factor， 咪 total 64個 factor。咁人哋都真係去到咁 sophisticated， 真係計得出嚟。咁但係咪攞呢64個 factor 一定會有個 predictive model 出咗嚟咧？佢答案又唔係喎，佢最多係 predictive power 1個月嘅啫。咁所以你話喺呢個 market 裏邊冇一條係 winning formula， 就算揾到俾你揾到有條 winning formula， 都會俾人好快搶咗去，跟住就會大家喺度摸，所以咧其實大家一路喺度摸嚟摸去，究竟邊度有問題？係啊，就係咁樣樣。
OK， 明白。即係呢個就可能唔係單一嘅方法，而係就住佢間公司再揾佢周邊嘅嘢。然之後去推斷佢流走。係啊，
個個都係咁。其實所有你依家見到所有嘅 scientific 嘅嘢，我都會知道咁。所有科研嘅嘢，你係估嘅 pattern。個行星點行，幾耐嚟到地球點樣轉咗365日，唔係421日，全部都係計出嚟噶嘛。observe 個 pattern。點解E 等於 MC square 啊？點解 F 等於 MA？ 呢啲全部都係 observation 計出嚟之後，揾翻條 formula prove 翻佢。只不過人哋 physics 做得到呢啲嘢。我哋呢啲咧，因為加入咗好多唔同嘅變化，就令到嗰個 noise 更加大咗好多。咁但係問題，如果你揾到個 formula， 可以用到個 pattern 嘅話，咁你明咯。嗱 pattern 講我可以教好多，有啲係 golden ratio， 有啲係Fibonacci， 有啲係跟住就有個譬如咩嗰啲底線啊、頸線啊嗰啲13個，我全部教晒嘅。跟住有啲咧就 multi-factor model 去 predict， 有啲咧就 fundamental DCF 去 predict。但問題咁多樣嘢裏邊，邊個行先？咁啊，梗係基本分析啦。技術分析嗰啲就始終都係話你係短期內得咯，但係長期內你係做唔到嘅。所以點解啲institutional fund 一定係用基本分析，就唔係用技術分析。短期短炒嗰啲係技術分析咯，係咁樣做咯。所以係咯，就係呢啲我喺之後幾堂都會講嘅。
好啊，好啊，唔該晒。
係啊，唔該。 So we're almost there. So we have 55 players. Show me the money. Who is this? Where are you? Please don't tell me you give up. You were hitting close to 100% return in few days. And you just cut loss, right? I know you're gonna get extra credit for that. Show me your hand. I want to know who you are. I have no idea who that is. 55% in 2 days. What the fuck? 係你啊？講到咁大聲，仲唔係你？係你啦，真係。Sorry， 一日係55。Overall returns is 87%. So one day just. So you check about this, check this, check this out. They only have like 4 stocks in the portfolio. Wow. Look at this, look at this.
Actually, it's so early. It's so early. It can be 2.4. It's gonna be 80%.
But one good thing is this. I am going to have I'm going to have a session with you. Let me. I really need you guys to show me the hands. How many of you wants me to conduct a Zoom, let's say a Zoom session at night, and I can explain to you about this market, the investment. You want that? Anyone? You guys will do it? Okay, let me set up a time. Let me set up time. Do you guys prefer weekdays at night or weekends in the morning is good? Okay. Okay. Weekday morning is not good, right? Okay, let me do something at night. Let me do something. What about if this is at night? Will that 9 p.m. is good or 8 p.m. is good? Okay, 9 p.m. 9 p.m. is actually better for me. Okay, let me do something like this. Let me use this particular trade strategy. Do you know what is short here? I'm not sure she intended or he or she is intended to do this. She wants to short the entire, so pretty much hit one particular stock with the entire AUM. And this one right here, this trade here, the system reject. Because you are not able to do that. But he was able to do a small amount. So what is the meaning of short? This is actually in your assignment number 1. I hope Eva explained to you what a short is. Short means when it is different from sell. SELL. So when you, in a typical trade, you will buy a stock. You own the stock first, and then the price goes up, and then you sell it later, right? So buy and sell. Financial engineer, they are very smart. They want to be creative. You have to buy first, then sell, right? What about if I give you the opportunity to sell first and then buy later? Do you want to do that? Yes. If you believe the stock is going down, it's going to go down. So let's say yesterday, Yesterday, stock is going to hit the bottom, NASDAQ especially. Then you want to sell first and then buy later. This particular mechanism is called a short sale, or in a simple word, that's short. So you short something, and then you buy it back later. You promise to buy it back later. Of course, when the stock goes from $100 to $50 in one night, then you make a lot of money. You make 100% return. But what if the stock goes up by $50? Then it will be a nightmare. So one of your classmates, I don't know who that is. I hope he or she is here. But this is a very nice trade. Very, very aggressive trade, but a nice call. You can see the trades here. Then this is not the only trade, because you can see there's a next page. There's next page. And by the way, 2:34 p.m. Eastern time. That is actually 3:34 a.m. Hong Kong time. So probably she is sleeping right. He or she is sleeping right now. She keep doing the trade until almost the market close. The market closed at 4 p.m. Eastern time, which means that it closed at 5 a.m. Hong Kong time. So probably she is not, or he or she is not here. Or are you here? Damn. Good. Finish the trade at 5 and then still coming to a class at 9. That's impressive. So this is how active he is. Particularly focus on one stock. So you can see how this is extremely aggressive. Entire portfolio dump into one stock, and then keep doing this and keep rolling this. And there is another stock, CELZ. Keep doing this day trade. Very interesting. Okay, this is the one. So you see that this is different. When you short something, that means you didn't own that stock. When you sell something, that means you own the stock already, you just sell it. So that's a different one. Are you able to see other people's trade list? Well, first of all, I don't want you guys to trade penny stock. I think I said the rules of anything below one, below one it cannot be traded. Yeah, I don't want you guys to go for penny stock. So that's good. Are you able to see everyone's trade? You're able to see other people's trade, right? Yes. Okay, that's good. You know how other people's work, so you can see if you want to follow their strategy. So let's get back here, and of course you can use a lot of day trading strategies. So that's a typical one of the riskiest strategy, and you don't need to calculate your portfolio risk, and of course there will be ups and downs from time to time. But some people do have the talents to spot the weakness. So the problem with CAPM, let me go through this really quick, and you can digest that yourself. In CAPM, the model actually is very unbelievably restrictive. So basically, CAPM cannot be applied in a practical world, in real world. So for instance, if you have the transaction cost, so when we talked about the bid-ask spread, so you know what bid-ask is. When you participate in the game, you know what bid-ask is. The price that you have to pay the market, the price that you can get it from the market. So that's the bid-ask spread. And the monthly return. The higher the bid-ask spread, the higher the return is. So if I tell you the bid-ask spread in the US market is much less, and the bid-ask spread in China market is wider, then you can see your expected monthly return will be much higher in Chinese stock. And it is not just in the stock world, but it's also in the fixed income world. Which asset class has the smallest bid-ask spread? It is the FX market. So in the 1980s, when you want to do US dollar to Japanese yen trade, you have to call up a broker, call up the bank. The bid-ask spread is huge, it's wide. So everyone makes the money. In the 1990s and year 2000, the bid-ask spread for a stock becomes narrower and narrower. The retail broker, when you want to buy a stock back then, 20 years ago, you need to call the broker. What is the price of HSBC? Can I buy it? And then a broker can fool you around. They will capture a huge bid-ask spread because they have another phone. Selling client, buying client. And then they do the mesh and you keep the spread. This is how they make money, the broker. Keeping the spread. But then when you have electronic platform released back in 2006, 2010, more and more people trade online. The bid-ask spread becomes much smaller and much smaller. And that is good because, as I said, CAPM model is based on zero transaction cost. Nowadays, basically 2-3 years ago, the US market started to have zero commission trading. Whenever you heard nowadays in Hong Kong, they said that, hey, you open up an account, you can trade US stocks for free. It is not that they offer you a free transaction cost, free commission. It's because the counterparty in the US charge nothing. It actually everything starts in the US. Anyone heard of the name Robinhood? Robinhood is the first trading firm offer zero commission. Everyone in the world trying to line up with them. So, Futon. What is the name? Futon. Well, they said you can buy the US stocks for free. It's not because they offer for free, because their counterparty it's offering for free. Some of the local brokerage firms, they still charge client almost 10 Hong Kong dollars per trade. That will be huge. But you can see everything seems like going towards the CAPM model. So as I said, in 10 years, the CAPM model can be deployed in Excel, but not nowadays. So you have the liquidity risk, and when you have the liquidity risk means it's something that when you some extra demand of money, of capital. So who got the liquidity issue? If you guys remember, so that you are still very young. There was an investment bank. Trust me, you were still a young boy, young girl. So that was 13 years ago. See, 13 years ago, there was an investment bank called Lehman Brothers, went bankrupt. The problem, liquidity. So when you have a liquidity crisis, then they serve a premium. So who needs money nowadays? Evergrande. Sometime a year. Evergrande, the real estate giants in China, they need capital, they need money. So what can they do? They keep selling the asset, selling the building at a huge discount. That's the liquidity. So nowadays it's the Evergrande. And of course the CAPM and the academic world. I'm not going to go through this, but it is crazy. And then the CAPM in the investments industry, they don't really care because it is hard to deploy the CAPM. So I want to cut short on this, but let me do some. This is what I usually do. Can I do this?
If you're losing money as a trader, here's why: emotion. That's the problem. See, Paul Tudor Jones is one of the greatest traders that ever lived.
Welcome to the world.
It is funny. It is funny. I actually I can see there are some. This one is Big Shot, a very great movie to watch out because it explains to you what happened in the financial crisis. And the good thing about movies is 2 hours you can see everything, and then you can see a lot of great actors in it. So Batman is here, you know, Christian Bale. Is that it? Christian Bale? So it's here, and there are a few famous actor here. Brad Pitt is also one of them. Anyway, so hope you guys have some fun spreadsheet. So we will have two more PowerPoints. So I hope I can cover this two. Very important one. The first one is APT. So someone did ask me if I can use beta to predict the market, or maybe I cannot. Then what is the what should I do to if there is any predictive model for the stock return? And yes, there is actually one. So I'm going to show this to you. APT and also multi-factor model. And I want you to learn a very, very important thing. EMH, efficient market hypothesis. This is the one that you're starting to bridge from the real world to the academic world. And I can tell you this, like 99% of the investors out there in Hong Kong or even in China have no idea what EMH is. And I'm sure that none of you probably understand what EMH is right now, because most of you guys will underestimate the power of EMH. And if you understand it thoroughly, clearly, then you know what to do. And it will help you to protect your investment, your wealth. So this is not about the cost. Well, to be honest with you, I care only like maybe 10% about the cost to do all the logistic. But for you to learn how to manage your asset, your wealth, that is more an important milestone for me. So I hope you guys learn what EMH is. And I can tell you that in the newspaper articles, like in the next few months, I definitely will write something about EMH because it was not saying that it will shock the world, but it will be like the first time someone from the academic area actually can bridge the actual world. So let's do this, and then after that's the next lecture, then I hope we are going to start the technical analysis, and then the fundamental analysis. So we will have sufficient time to do that. Well, I hope at least. Yeah. So let's see. There should be a small one. So let me go back just a few more slides before CAPM. So what capital asset pricing model is? I gave you the beta of the stock, which you can calculate. The beta is the correlation coefficient of the stock to the market. How do you calculate that? You have the last 5 years, let's say monthly return or daily return or weekly return. And then you have the last 5 years markets, daily return, weekly return, monthly return. You have two columns here in Excel, and then you just do the correlation coefficient. That's beta. That's it. And of course, you have to, if you want to write down the formula, that will be the covariance divided by variance between these two factors, right? So when you search on the internet, how do I calculate beta? There are tons and tons of materials for you, and even someone build the Excel file for you. So that's historical beta. Why and how do you use this? Let's say if I said Tesla is 2.1, beta 2.1. And if you expect the market is going to go let's say 10%, right? Go up by 10%. Then Tesla will be expected to be 21% return this year. Very straightforward. Of course, there are a lot of flaws inside because the problem is beta. It's a historical beta. It is not the forecasting beta. Then the question is, can I get a forecasting beta? Yeah, of course. This is why you need to learn statistics before you get into the business school, or maybe at least the first year in business school. In a statistic course, do you guys remember what a regression is? When you run a regression from a series of data, like different plots, and then you can pretty much do a forecast equation, right? If X is happening at this, Y will be something like this. CAPM is easier because the regression model, it becomes a one single straight line formula, Y equals MX plus C. In your regression model, it can be I'm not saying a second degree, but it will be a quadratic equation, which means it will be Y equals A squared plus whatever that is. So that will be a quadratic equation, a little bit more complicated. It's still a regression, but that's where we stop right here. We don't care about like the multi degree variation, but if you're able to run a regression, okay, the market will perform like this, then the stock will perform like this. So you have two variables, right? Market does this, then you will be like this. You will be like this. I give you a beta, and then you'll give me the expected return of the stock. That's easy, right? But that's not accurate. So what happened is, before that, it's a CAPM model, one single factor model. Now it is the multi-factor model, arbitrage pricing theory, APT. This shall complete the entire story. So first of all, APT is arbitrage pricing model. Arbitrage, I'm sure that every one of you here wants to plot this point. Arbitrage means it is a gain without any risk. Is it for real? Of course, it is not. There is no free lunch. So remember this, whenever you get a phone call from someone else claiming that, hey, you want $1 million, can I do something XYZ? Then you know that there's no free lunch. There's always no free lunch. There will always be a transaction cost involved or even fraudulent call. But arbitrage, well, at least we have to set up a term, means that you can extract the mispricing in some profit, some kind of profit. So risk-free profits. That is the key. And for CAPM, generalize the SML line for CAPM, then it will become the APT and also the MFM, the multi-factor model. So what happened is this: if one factor is not sufficient because it's too general, what if we put more factors in? If I put the beta, which is against the market return, if I put more, let's say if I put inflation rate, interest rate, unemployment rate, volatility of the stock, volatility of the market, would it increase the predictability of the formula? Yes. I don't care how many 100, 200 variables, if I come into the model and it has even 2% of the accuracy, I will do that. This is what we hunt for. Many people are trying to do this for like many years. And this is what we hope for. Even 2% of improvement of the accuracy. So this is how we do the extra market risk factors and all these things. So now you heard of the beta, and then we have the alpha, and then we have gamma, gamma first, delta and beta, and then you see this after lambda mu. You heard about the mu variance in COVID, and then it should be a nu and then C, and then Omicron, they skip this and then it becomes Omicron. Exactly, that's the case. And then at the end you have the sigma, and then you have the omega. So all these are the Greek alphabets. Right? So we're going to learn a lot of alphabets in investments. So you know what beta is. And this particular formula, it is not complicated. It's still a straight line formula. Everything is still a straight line formula. But we have the expected return plus the beta times the factor, and then plus the epsilon. That's the expected return of the security. So that will be the stock right here. So you learned this particular slide before. But then the factor model. Before that, this one has one factor, which is the market variable. But now, can we put in more factors? So let's do a multi-factor model. And let me introduce you. There is actually one firm pioneered to do that. It's Barra Inc. BARRA. It was later acquired by Morgan Stanley. So Morgan Stanley Barra, MSCI Barra. This guy introduced this multi-factor model back in 1976, and the owner is still here. The owner was a PhD in Berkeley, so he actually, when he first started, he drew the equation on a whiteboard, and the whiteboard is still at Berkeley because I've seen it. It is still in Berkeley in the headquarters office, because that was the one board that became the public company and later acquired by Morgan Stanley. And people, professional institutional firms will trust this model more than their own. So this is very important. Of course, like it's a high price, high charge. But look at the factors. Look at the factors of how they classify. There are 8 different factor groups, 16 factors, and actually 16 factors, and below that there is a sub-factors. And total, there are more than 64 factors that I can encounter. And they spread it out into different perspectives. No longer relied on the market return, but they will drill into the stock specific components. You will see the liquidity, which is cash balance, the volatility of the stock, and then the yield of the stock. So let's say how much percent return you can get. And so on and so forth. Quality, momentum, value, size of the stock, the growth of the stock. And then within the growth, there will be revenue growth, net income growth, and all the other smaller variables. So there are 16 major factors, but there are a lot more sub-factors that you can see. With all this, we'll go into one single formula. And here, I simplify this one for you. So let's say if you are interested in working with the GDP and also the interest rate, then you have 2 factors, right? 2 factors model. Expected return plus this, and then plus the epsilon, that will be the stock return. So once you set up the formula, then you use this formula to run against the regression. That's it. And I can tell you, for those who wants to pursue PhD degree, this is exactly what you need to do. You think of something, you put the observation into a formula, and then you test the formula. And if that's you succeed to do that, then you get the PhD. That's it. So it is not that hard. Again, the key is observation. You want to put all the observations into a formula. This is how Albert Einstein, this is how Isaac Newton get the Nobel Prize. Even Stephen Hawking. You put the observations of pattern into the useful formula. Of course, finance, it will be hard because there are a lot of noises that you are not able to capture into a particular formula, because there are 3 different styles: technical analysis, fundamental analysis, and there is actually a 3rd one. It's called behavioral analysis. For the behavioral analysis, I will not be able to cover that for you because we have a very short time. For the behavioral analysis, I will put the slide to you, and it won't be in the syllabus. It won't be in the quiz, but just FYI. So there are 3 school of thoughts nowadays that will be in charge of the entire universe, entire investment. It doesn't matter whether you're in the US or in Hong Kong. Technical, fundamental, behavioral. If there's a huge market collapse, always behavioral. When there's a short-term trading, always technical. When there is a long-term momentum, long-term growth, that's always fundamental. So this is how it works. So Ross is the ones to developed by the arbitrage pricing model, and I'm not going to go through all the details here, but he uses the SML and then try to extrapolate that and formulate a better one, a better model, and call the APT. And with that, of course, law of one price, you cannot have arbitrage, or even if you have arbitrage, there has to be transaction cost and other let's say storage cost involved. So law of one price, what does that mean? So you probably learned that from the marketing, right? When the price of one burger should be the same, doesn't matter where you are. In Europe, in US, in Hong Kong, in China, in India, Japan, you always have one. But if there is any price differences, it always come down to the arbitrage. Basically, what you want to do is you want to buy the hamburger in Hong Kong or Malaysia, and then you sell it to Norway, right? That's arbitrage. Buy in Hong Kong at low price, $1.70, and then you sell it in Norway, $7. That's arbitrage of over $5.30. That's good, right? Assume you don't need any transportation cost or any storage cost or any tax, tariffs, government intervention, right? So this is how this is what the law of one price is. And you always have a problem with that. So this always exists. And in this case, so if assume that the APT works this way with the arbitrage, and then the next thing we want to focus on is we want to have a well-diversified portfolio, which means that try not to invest $500,000 in one shot. Diversify yourself and try to make some good return. You can invest something like this, but maybe you put 5% of your entire wealth into doing this kind of day trading. That's good, but then you don't want to put your entire wealth as a gamble, right? So this is something that I don't need to tell you. And so these two things is the excess return. On the left-hand side, chart A, you can see every single securities line on the same on the same line, SML, right? I didn't even put the what F is. F is actually the that's in theory, but in reality, that's on the left on the right-hand side, chart B. All the investments will be going higher or lower than the line, the blue line here. So in this case, you will be able to spot any particular alpha, extra or excess return, or excess return. So you can see how the macro factor will be different. So this is no longer beta, but it will be changed to F. So a macro factor, and you can see there could be some differences between these two, A and B. So what is the SML for APT? APT, as I said, is an improved version. So you will have more than just one variable. So you will have so for now you have one beta, and then try to understand the SML. Anything that is undervalued, you want to buy. Above the line, you want to buy. Anything below the line, you want to short, right? And as you can see, aggressive securities and defensive securities. HSBC is defensive ones, the ones with the utility is defensive. Aggressive means it is actually more volatile. Anything below one will be defensive, anything above one will be aggressive. So try to remember this particular chart right here. In C will be the one you want to short. Anything above this line will be undervalued that you want to buy. So that's the risk of premium for F. Again, this is not just the beta, but it's a multi-factor view. So what is the comparison between the APT and CAPM? Let me blow this out. APT is a multi-factor model. It can be macro, it can be fundamental, it can be statistical. And so there will be a lot of relationship, and it does not assume investors and mean variance optimizer. So it's a and you don't worry about this one. But CAPM, it's about one single factor, which is the single market beta. That is a key difference. So the multi-factor APP, as I explained to you, there will be a two factor. One is beta, and F1, F2 is the factor itself. So you have the factor, and then you have the beta of that factor. So you will have the market. And so let's say if this is a single formula, single factor, then you have the beta and also the market return, right? But now instead of market return, we will replace by F1, F2, and all the way down. So this is only two factors. In Barrow model, they have 64 factors to it, and running this in regression. Oh, it's right here. So APT are the factor portfolio. So beta 1 for one of the factors, and all the way B0 is for all other factors. So this will be the one of the samples. One of the very famous from the academic area, even some people are using this. It's a family French. So we call it FF3 factor model. So what happened is they have the small value against the big value, and then one is the small minus big, and then high minus low, and then there's another one, 1, 2, and then the market. So three of them. Small minus big is the return of the portfolio minus the excess return of large stock and small stocks, and then high minus low is they use the book to market ratio. So I will explain to you what the book to market is. So they have 1, 2, and 3 factor model, and then running against the excess return, and then the epsilon, and then get the total return of a particular stock. You can this particular formula works pretty well in the, I think we have yes. So look at this Amazon. Again, 5 years ending in 2018. If you use a single factor model, so just using a beta, then you can see the predictive power. How do you read the predictive power? R squared. So R squared is the correlation coefficient. R squared 0.286. But then if you use the three-factor model, the R squared is 0.455. That's actually quite high. Your predictive power is, you can explain close to 45% of the move with the three-factor model. And you think, hey, can I find something that is close to 90%? I wish I can. And I hope you can. You can actually do something like this. Try to dump into the fourth factor, the 5 factor, the 6 factor into the model, and then see if you can find out the R squared. So R squared is everything. How can you run the R squared? Again, go to the internet. How can I run regression in Excel? And then a multi-factor model in Excel. It will give you a model to give everything. This is how you can come up with the three-factor model, and or even a multi-factor models, and calculate that. And again, the factors here in the three family French three-factor FF, they use the let's say the size of the company. They use this, and then a high minus low, big minus small, and the market return. Can you think of something else? Sure. You can use the earnings, you can use the risk, you can use whatever you want to do this. So this is the pretty much the CAPM. Let me see. I have I think I have one more slide here. Let's do the Wonder Woman. No, impossible. So I gotta say the commercials from the other side is from the other side of the world, Thailand, US, they are actually quite impressive. Let me give a quick intro to you. Efficient market hypothesis. This is extremely important. I will use the next half hour, hopefully half hour, to explain to you this EMH thing. But if you want to do investment, real investment, this EMH is everything. So it's all about information. And don't worry about this question. I'm not holding questions. I will have another one for you. So one thing I want you to let's say scan this. You read the slide of this, and there's actually one particular slide. I want you to see. This is the version. This is the table. And again, ICA or the quiz will definitely have questions on this particular one. So try to understand what's going on with the EMH. Because if you don't understand the EMH, it will be really hard for you to understand what's going on in the whole wide world. All right, this is the one page I will emphasize, and let's wrap up today. And I will see you next Friday. Is that next Friday? Yes, next Friday. All right, thank you.